Welcome to the deep dive. In today's financial world, really understanding how companies present their performance, it's not just helpful, it's absolutely crucial. We're diving into that mix of art, science, and sometimes, let's be honest, a bit of strategic maneuvering in financial reporting. So our mission today is to unpack the subtle differences between what people often call creative accounting and, outright financial fraud. And crucially, we want to get a handle on the indispensable role auditors play in navigating this, sometimes a pretty murky landscape for all of us. We're going deep into excerpts from massagingthefigures.pdf. It's a really interesting source, pulls insights from a 2008 KPMG survey, and of course the key auditing standards that sort of guide this whole process.
Yeah, and straight off the bat, a key finding from that KPMG survey really sets the scene. It surveyed audit committee members, and it highlighted the increased risk of earnings management as a major concern, especially, for companies hit hard by global economic downturns. This isn't just theory for auditors. It's a real high-stakes challenge they face day in, day out.
Okay, let's unpack that then. Earnings management, it sounds a bit like corporate jargon, maybe spin. What exactly is it, and why is it such a worry?
Right. So basically, earnings management is when a company deliberately plays with its revenues or expenses. The aim is usually to inflate or sometimes deflate their reported profits and earnings per share figures. Think of it as using creative accounting techniques to, paint the financial picture management wants you, the investor, to see. And it's really not uncommon.
That makes sense. I mean, you hear about the pressure finance directors or controllers are under. They've often got senior management breathing down their necks to hit certain profit targets, right? Mm-hmm. And I imagine that ramps up massively in tough economic times, when revenues are down, or maybe big costs like asset write-downs hit the bottom line. That must be where the temptation starts.
Exactly. You've hit a key point there. Because what's often missed is that earnings management doesn't always mean breaking laws or, violating accounting rules directly. It's often more about bending the rules. A company might choose an accounting policy that's technically allowed under the standards, but maybe it doesn't fully reflect the economic reality of what's actually happening in the business. So, for instance, imagine a company changes the estimated useful life of some big piece of machinery. Accounting standards often allow for that kind of estimation change. But if they extend that life just to lower the annual depreciation charge and therefore boost reported earnings for that year, that's a classic example of earnings management. They haven't broken a specific rule, perhaps, but they've definitely massaged the figures.
Okay, right. Here's where it gets really fascinating for us then. If it's bending the rules, but it's still sort of allowed, how on earth does an auditor figure out if it's crossed that line, that subtle line into something much more serious, something actually fraudulent? That sounds incredibly difficult.
It is. It really is the auditor's tightrope walk. Because financial reporting standards, they inherently have flexibility built in. Financial statements rely heavily on judgments, on estimates. There's wiggle room. And that flexibility means it can be genuinely hard to distinguish between, say, an acceptable accounting choice and one that crosses the line, breaches the rules, and becomes fraudulent. The absolute key difference with fraudulent financial reporting is intent. It's a deliberate misstatement in the financial statements. This could mean, actively falsifying the accounting records underneath, or intentionally ignoring a specific accounting standard, or knowingly leaving out information that absolutely should be disclosed. Like a concrete example. Say a company deliberately fails to disclose a major potential lawsuit, something accounting rules say they must reveal. Or perhaps they hide serious going concern problems, doubts about whether they can even continue operating. Intentionally omitting required disclosures like these. According to the auditing standards on fraud, like ISA 240, those are clear examples of fraudulent financial reporting. And those same auditing standards, ISA 240 again, they point out that the motivation, the incentive, or pressure to commit fraud often comes when management is under the gun, desperate to achieve an expected, maybe even unrealistic, earnings target. Missing those targets can have big consequences for managers, so the pressure pushes them towards hiding things or using policies that create misleading results.
Wow. Okay, so what does this actually mean for the auditors then? When they walk into a company, what are they specifically looking for? And what are their responsibilities when they get that gut feeling that something's not quite right?
Right. This is where the auditor's job becomes so critical, and it's all guided by their professional standards. First off, auditors must approach their work with professional skepticism. Now, that isn't just being cynical. It's a deep questioning mindset. You challenge things, you critically assess the evidence, you stay alert for anything that might hint at misstatement, whether it's an accident or deliberate fraud. You don't just accept management's word. And secondly, The standards like ISA 315 and 240 specifically require the audit team to discuss where the financials might be susceptible to fraud. They need to brainstorm, challenge assumptions, basically try to think like someone who might commit fraud to spot potential weaknesses or red flags. Auditors also have to pay really close attention to how a company chooses and applies its accounting policies, especially for complicated transactions or areas needing subjective judgment. They're looking for any hint of bias in those choices or estimates, because bias could be a signpost pointing towards a risk of fraud. And particularly in difficult economic times, when management might be tempted to hide bad news.
Auditors need to be extra vigilant. They have to make sure that all the relevant information, even the uncomfortable stuff, gets fully disclosed in the financial statements, just like the accounting standards demand. It all builds up to a crucial decision point for the auditor when they write their report. Is this earnings management we're seeing still within the bounds of generally accepted accounting principles? Do the financials still give a fair view? Or is it so aggressive, so far over the line, that it actually breaches accounting rules and is therefore fraudulent? If there's a clear breach, maybe standards were misapplied, that leads to a disagreement with management. And that can mean a qualified opinion in the audit report, which is a serious red flag for investors. And beyond just the audit report, auditors have other really important reporting duties. If they find instances of fraudulent financial reporting, they must communicate that promptly to those charged with governance. That's usually the board of directors or the audit committee, the people providing oversight.
And ISA 240 also points out that in many jurisdictions, auditors might need to report to regulators, enforcement authorities, or sometimes even directly to shareholders, maybe at a general meeting. What's really quite fascinating here is how the standards give you this framework, this structure, but the actual judgment call, that often boils down to the auditor's skill, their experience, and how rigorously they apply these principles in really complex real-world situations.
So just to sort of bring it all together, given the current global economic climate, auditors are essentially walking into a much higher risk situation, aren't they? You've got the preparers, the finance teams, under immense pressure to make the company look good. And they have these tools available, whether it's bending the rules with earnings management or actually breaking them with fraud. It just means auditors have to be incredibly sharp. Their risk assessments, their procedures, they need to be designed to sniff out manipulation and figure out, okay, is this just bending or is it an actual break?
Yeah, it seems crystal clear that the line between, bending the rules and breaking them for financial gain can be incredibly fine. And that puts enormous pressure on the auditors, the ones tasked with ensuring financial integrity for the rest of us.
Exactly. And the takeaway isn't just for auditors. Given the current economic circumstances, it means all of us, shareholders, potential investors, anyone looking at financial statements probably need to approach them with, an increased degree of skepticism. Ask more questions. Which really leaves us with a final thought, doesn't it? If the accounting standards themselves allow for flexibility and judgment, and managers are facing relentless pressure to hit those targets, how much of what we read in financial reports is, a truly objective picture of a company's health, and how much might be, a carefully constructed narrative designed to shape how we see things? What extra questions should you be asking next time you look at a company's performance figures?